Good afternoon, everyone, and welcome to today's webinar hosted by Region 10 chapters of HFMA. The title of today's webinar is Trends in Healthcare Debt Financing. I'd like to welcome today's guest presenters. We have Ross Holland and Jason Dopoulos. Ross is the Vice President with Lancaster Pollard, a financial services-based firm in Columbus, Ohio. They specialize in providing capital funding to the senior living, healthcare, and affordable housing sectors. He holds registered securities, including Series 52 and Series 79 licenses. Jason serves as the Managing Director with Lancaster Poland. Through his tenure at Lancaster Poland, Jason has structured a range of bond transactions and mortgage loans for over 100 expansion, new construction, and refinancing projects with a total loan amount that exceeded $3 billion. So, without further delay, I'll hand the call over to our guest presenters. Ross, I believe you're up first.
Thank you, Nikki, very much for the introduction, and thank you everybody for dialing in and taking the time out of your day to visit with us. As Nikki mentioned, Lancaster Pollard is really just a full services financial services firm dedicated to the healthcare space. We are a commercial mortgage bank, an investment bank, an advisory firm, and we work with healthcare organizations, hospitals, and skilled nursing providers to structure and advise on their financing transactions. The presentation we're going to go through today is really just geared towards sort of an overview of the current environment in healthcare debt financing. That's impacted obviously by a lot of different things, from the economic environment to trends in regulatory issues and the like. And we're going to go through to start just an overview and an outlook in the economic and capital markets. So that's where I'm going to start. First and foremost, I think that every presentation that Jason and I give on this topic over the past few years, one of the primary goals of it has been to discuss where we are in the interest rate environment. We've been saying for years that the interest rate environment is going to change and start to normalize from historic lows that were really a function of the financial crisis. And that has started to happen finally to some extent as we've kind of transitioned from 2017 into 2018. I will note that this data slide is updated quarterly on our side, so it's a little bit stale, but it's about similar to the current market environment and really kind of captures I think the trend that we need to focus on here. Just to give a little bit of a barometer, even though there's a lot of data on this slide, and I'm not going to go through all of it, but I think that the biggest point is just pointing out where yields are today versus where they were within the last couple of years, and even really just a year ago. The 10-year Treasury, as I'm sure that a lot of you have followed, is really about, as of today, I think I looked this morning and it was about 283 at open this morning, which is roughly 60 or so basis points higher than where we were a year ago. And I don't have to tell anybody on the line how much that can impact borrowing costs and what 60 basis points can mean to providers. A big driver of this has obviously been the change in the economic environment, the recovery that we've really been in over the past 7+ years has started to, at least in the Fed's eyes, come to fruition a little bit. Inflation has begun to pick back up, albeit not at the same pace as to what they're targeting. The unemployment rate is at a relative historic low, and we also continue to see some pretty decent strength in jobless claims and retail sales. So I think that sort of the takeaway from this slide is that the environment is starting to change, and it's really the change that's been coming gradually that we've expected over the course of the past couple of years. So continuing on, sort of the same topic. This is just a little bit more data that you can kind of see from rates and yields. Now, even after the Fed has increased rates, and really, I guess I should pause for a second because an increase in rates is really just driven by the Federal Reserve changing their target rate. Now, they don't have necessarily the power to just go change interest rate indexes, obviously, but setting their target rates at higher levels and really just impacting how the banks lend to one another is at its core how the interest rate environment is really adjusted. And I think that the point here is that even compared to a slight increase in the Fed rate increase, Fed rate targets, we've seen healthcare yields continue to be really attractive for borrowers. I mean, from a long-term perspective, even if rates on the 10-year Treasury side are up 60 or so basis points from where they were a year ago, we're still very low historically speaking. So I think that it's kind of seeing the forest through the trees a little bit. And I know that Jason and I have seen that a lot from our clients, and that they'll get concerned over the relative rise in rates. But one of the things to keep in mind is that when you're borrowing on a long-term basis, chances are that even executions today are going to be very, very attractive 5, 10, 15 years from now.
Yeah, I think, Ross, this is Jason. One thing to look at is, an increase in the short end of the yield curve, rarely corresponds with a commensurate increase in long-term bonds, as you stated. So, when we get into some of the options that hospitals use for financing, there's structures of using serial bonds and other ways to take advantage of the yield curve. But, what we're seeing is just, short-term rates go up as we expected, but, long-term rates remain historically very, very attractive if you look at, decades before us or even 5, 10-year trends.
Yep. And kind of just continuing that discussion, I mean, part of the reason and really the largest reason that the Fed has started to gradually target rate increases is because they're finally starting to see what they want to with respect to inflation. Now, inflation has certainly gone up a little bit. That's partially driven by just a more robust labor market. The unemployment rate, as I mentioned, is pretty low right now. So there's a lot of folks out there with the jobs that they want and the jobs that they need, and they're driving purchasing and retail sales. So we have seen a little bit of that, and commensurate with that is the Fed's increase in target rates. But we're still at a point where I think inflation is a little bit lower than the Fed would like to see it. So that'll be interesting how it plays out over the next year or so. Really the way the Fed kind of tries to balance it is they say, we want to drive inflation, so we don't want to raise rates too fast, but at the same time we want to make sure that there's not a disequilibrium of sorts between long-term interest rates and inflation, or else if you have higher inflation and they don't do anything with rates, then obviously that makes the economy sputter a little bit. So that's kind of just an overview of the interest rate environment in general. Now, as far as how that is impacting municipal bonds, we'll get into that a little bit over the course of the next couple slides. So the municipal bond market in general, and part of the reason we like to go through this is because it's such a big part of the debt markets for healthcare providers, whether it be smaller, rural, or even critical access hospitals or larger systems. The muni bond market is obviously pretty relevant. So I think that one interesting point to point out is that since the financial crisis, private placements, which is essentially just selling a municipal bond to one buyer, typically a bank, have risen in popularity, and that's really because the public markets have been a little bit more difficult to access as credit quality has become more of a focal point, and private placements are a way to take advantage of the tax exempt market while not sort of running the risk of getting a below expected rating or something else that's going to drive up your yield in the public markets. One important sidecar here, though, is that a popular vehicle for hospital systems to take advantage of the low interest rates we've been in over the past 5 to 10 years is what's called a tax exempt advance refunding. And what that essentially is it's a refunding of existing bonds using an escrow account where it's more or less cash collateralized with low risk and government securities in order to basically lock in the lower interest rates earlier, even when the bonds that you have outstanding are not prepayable. So think about it as a way to sort of forward, to forward take advantage of lower yields when maybe you did a debt deal or a bond deal when interest rates are a little bit higher. Now, part of the difficulty we've seen with that in 2018 is that HR1, which was the Tax Cuts and Jobs Act that President Trump signed into law in December of 2017, has actually eliminated the ability to do an advance refunding on a tax exempt basis. And what that means is that you can still do an advance refunding and escrow bonds and defease them prior to their call date. You just have to do it with taxable proceeds. So the only way to make that make sense is if you've got tax exempt bonds that were done during a time period where even tax exempt rates were less advantageous than today's taxable rates. So you used to be able to advance refund your bonds using the same tax exempt market that the bonds were initially done under. But now if you're going to do that, the math really has to make sense where you'd be able to refund those bonds using taxable proceeds. And I know that that's one thing that a lot of our clients were concerned about. And I think that's also why you saw a rash of advance refundings prior to the end of 2017, because everybody kind of knew this was coming. So I don't know, Jason, if you have any more thoughts on that. I know you've talked to a lot of our clients about that particular issue.
Yeah, and since I'm popping in and out, just to introduce myself, my name is Jason Dopoulos, and I run Lancaster, Pollard, the regions that cover Region 10 and actually 11 for HFMA. So we have a office in Bozeman, Denver, and Newport Beach that kind of covers all the people that might be on the phone here. So what we found is when the Trump administration was deciding what to do on taxes, there were various proposals being thrown out. One of them initially would have, almost cut the ability for, cities or counties to even issue tax exempt bonds, which, 501c3s for hospitals, they're, they're not public entities. They're just, private, nonprofit organizations. So there was a rush for people to try to get deals done for the end of the year. A lot of lobbying was being done by, the AHA and other groups. So we got to a point where, we still lost a valuable technique of advance refunders, which, when interest rates go down, is a good way to lock in savings for your hospital or your community. But they kept, some other items like private activity bonds and the ability to finance stadiums and other stuff that, there was heavy lobbies going on. So, we ended up okay, but also, one thing that did happen, which, you can argue either side, right? But the lower tax rate for corporations, from 35 down to 21, that could potentially lead to a drop in demand for municipal bonds or higher return requirements from investors. Because if you think about it, investors invest in municipal bonds because it's tax exempt to them. And in states like California, where it's triple tax exempt, if you invest in a California bond where, state taxes are high, local taxes are high, the federal taxes, there's high demand for that. States with no, state tax maybe a little lower, but in general, we might see a little bump up in rates. It's too early to tell, but, basically, what we ended up with was, we lost one tool, which the market's trying to figure out ways to, get our way around, the advanced refund deals. We lost that one tool for our clients, and then, we'll see what happens with rates. But, nothing dramatic has happened. I just think you saw a big bump in issuance at the end of, the year, driven more by fear that you couldn't issue tax exempt bonds, which, would have been a big change. But, that's why you'll see a bump in the market, the fourth quarter of last year.
Yeah, no, thanks. That's good. That's good perspective. I think that, and just the next couple slides as we wrap up really this part of the talk, it's just a reiteration of a few of the things we've talked about. Generally, I think that you've seen in 2017, you did see yields kind of rally, even though we're above the all-time lows. Yields are still low on a historical basis, and I think that's really the takeaway. There was a little bit more concern because of the unknown at the end of 2016. I think that whenever people are expecting the Fed to price in increases, they tend to over as opposed to underreact. So it's kind of an interesting dynamic where you're status quo, then people expect rates to go up, so they adjust, or over adjust, and then ultimately rates did go up, but kind of settled into a yield point that is still definitely above or definitely below the average for sort of the historical period we've been in. And then likewise, it kind of makes sense that spreads kind of came back in 2017 as they widened at the end of 2016, just in order to sort of calibrate for the risk that folks didn't know whether or not rates were going to go up a ton or just a little bit or sort of somewhere in between. So that's kind of a general framework for where we are today, really just in the overall capital markets. One of the things that can obviously impact the pricing that healthcare organizations access on debt is their rating, or whether they choose to get rated or anything like that. So we thought it would be good to go through just a quick update on where the rating agencies are today, how they've changed in terms of their outlook, and really how they're seeing things going forward. Just a quick tutorial. There's probably not that many folks on the phone who are not familiar with this, but Standard & Poor's, Fitch, and Moody's are really the big three rating agencies, and the most important line for most healthcare providers is that line between good credit grade and speculative grade credit, because that's what drives whether your bonds are an investment grade bond or a speculative grade or a junk bond, and that can impact your pricing significantly. So when going back to what I mentioned about the option where you can privately place bonds with a bank, part of the reason that's become so popular is because if you're a health system or a nonprofit CCRC or some other type of provider that is kind of close to investment grade, but it's hard to say for sure whether you'd be able to achieve an investment grade rating, you can really kind of sidestep that risk by engaging in a private placement process, because that usually mitigates the need to get a formal credit rating. So that's just a little bit more background. Now, as far as the ratios go, there's a lot of data here, and I'm sure that some of you can review this after the webinar. So I don't feel the need to necessarily go through all the ratios, but I think that the point that we're kind of seeing is that because of the pressures in the labor market, and growing but frankly slower growing revenue, a lot of the rating agencies, including the big three, are starting to sort of comment that they've seen some more operating pressures leading to more negative outlooks. And the median ratios, particularly from Fitch in 2017, pretty much went down across the board. So I think that the takeaway here is that labor expenses, sort of operating pressure, have really lowered profitability and tempered the growth of liquidity ratios, which is one of the most important drivers of what kind of rating you're able to get as a health system. And a little bit more from just the rating agencies. It's no surprise or secret that smaller hospitals have had a harder time driving credit quality and sort of meeting ratios that they would need to get rated than larger systems for obvious reasons. They don't have the purchasing power scale for goods and services. It's a little bit harder for them to manage their labor, because when you only have a pool of smaller labor, you're in a smaller market, it can be more difficult to be appropriately staffed. But I think that beyond the obvious point that it's harder to maintain strong credit ratios as a smaller provider, it's also worth pointing out that even if you have ratios that meet or exceed the levels of some of the larger providers, it's actually harder to get the same rating. And the reason is because just sort of the systemic risk associated with maintaining that position is viewed by the rating agencies as being a little bit more difficult. So even though, you might have the same days cash on hand, or you may have the same operating margin as a larger system, some of the rating agencies kind of look at that and they say, well, because of the fact that losing a couple of big physicians can really impact a smaller provider more than a larger one, it's tougher to get the same rating with the same ratios. So what I'm going to do next is pass it off to Jason to go through some of the select financing options that we're seeing in the market today, and to kind of explain the pros and cons, and then also go through some case studies. So Jason, if you want to start talking about with revenue bonds, we'll go from there.
Sure. So, the topics we're covering here, because we have limited time for the financing world, are really the type of financing you would use for capital projects. I mean, obviously, within the realm of borrowing for hospitals, there's, accounts receivable financing, lines of credit, other things like that are really cash flow based, revenue cycle kind of based. So we're kind of, or short-term bank debt as well. We're kind of going to put that aside and kind of go through options we see for both, large systems, small systems. We'll cover stuff that might be available for rural hospitals. We know there's several of those in the region we're speaking to, and just go over kind of what these basics are. And as Ross said, this PowerPoint could be kind of a takeaway of kind of high level of different options. So I'll start with what is probably the most prevalent, and that's revenue bonds. Now, general tax exempt bonds, which Ross went over some of the curves with you. There's revenue bonds, which if you see here, they're limited to the obligations of the borrower. So just the hospital, right? The hospital and its assets are, pledged to the trustee, and they're the backing for the bonds. It's just like, if I own my own company, I went to the bank or went to issue bonds. It's my creditworthiness that determines the interest rate and who's interested in buying my bonds. Now, you can also have, general obligation bonds where, a hospital might be a district or something and have, tax proceeds from the actual district or county or city that the hospital's in. If they go to the voters and ask for kind of ad valorem taxes. So that's a possibility, but and the bonds would be the same. So how they turn out, it's just that would affect your credit, and it's kind of like credit enhancement. But revenue bonds, you see here, it's based on your credit, and you can issue bonds directly. You go through an issuing authority, which every state has, and they're kind of conduit for your bonds. Pros and cons, it's the fixed rate structure, right? 25 to 35-year amortization period. So there's really no refinance risk. So if rates are low today, you can issue and have that same rate, almost like a home mortgage, right? A fixed home mortgage for almost 30 years. The one issue that, the reason you saw a lot of refinancings at the end of the year with that change in the tax law, the ability to advance or fund one of these bonds, it was one of the big benefits. So, going back to Ross's rating agency slides, if you issued bonds today at BBB minus for 6%, let's say, and then in 4 years, your household's rated A because you've done better, you've increased your credit profile, and you might want to refinance those bonds. Historically, you would do an advance refunder and issue new bonds that were, at a lower rate that would defease the old ones. Now, that's something you can't do. So we have to be more careful with our clients in evaluating their future prospects to decide what kind of lockouts or prepayments we should have on the bonds. You can go to market pretty quick, 3 to 4 months. Once you get a trust indenture in place, you can add more debt, do different series. So it really just is something that's flexible for you in that sense. Some of the negatives are, like I said, it can lock in your credit profile, right? Because they usually have 10-year lockout periods. If you do private placements with banks, a lot of times there's a balloon payment, so you got to be very careful in how you structure them. And there's covenants in both for rate, debt service coverage, and liquidity covenants. So when you do a bond deal, you're actually negotiating with bondholders, which are large entities. They might be pension funds, groups like PIMCO, big investors that have, specific areas that invest in tax-exempt bonds. You're really just negotiating with that party over what rate and terms you should get. But this is the most used for rated hospitals. It's they use this the most because once you're rated by one of the agencies, you're kind of you're easily understood by the investment community, and we can bring you to market quickly and get deals done. When you're not rated, or you're below BBB minus, which is considered a junk bond or non-investment grade credit, that's when some of these other options I'm going to go over can be beneficial, and that happens a lot for community hospitals, rural hospitals, critical access hospitals, hospitals that don't have scale or aren't backed by a district or the taxing population of their community. So this by far is what you see most hospitals do across the country. Ross, you can go to the next slide. So there does exist within the realm of options for hospitals 2 governmental programs that are really, are used for, urban hospitals, this first program, and there's a program for rural hospitals, and really for hospitals that are, we would say, vitally needed by the community. They're not, hospitals in the nicer suburb that's kind of getting the higher Medicare mix. These are hospitals that cannot leave, right? They're providing care for a high Medicaid population. There's not other competitors nearby. They're kind of like, the hospital has to stay. The first program that we use a lot is through the FHA, the Federal Housing Administration. It's very similar to, how FHA insures home mortgages, right? I mean, they insure people's mortgages, and then if those people default, the federal government pays the claim. It's the same mechanism. So what you get under the pros here is you get AA rated credit, right? Because the government insures your loan. It's 25-year amortization, fixed rate. There's really no covenants compared to a bond deal. Again, kind of like a home loan, pay your mortgage and you're kind of left alone. And there's a second loan program for future capital needs. The negatives are, if you think about it, you're dealing with the government. It takes a little longer, 9 to 12 months to start to finish. If you're building something, you have to use Davis-Bacon union wages, which for some hospitals it really doesn't matter depending on your location. Urban versus rural, you may be required to use union wages and bid it out that way anyway. You pay the federal government an annual credit enhancement fee. That's part of your interest rate. And then it has a debt service reserve requirement, which is we're getting kind of into technical parts here. It's not a huge negative, but it's something that sometimes, but the bond markets only require 1 year. But this program can be used for construction or refinance. You don't have to be rated, right? And everyone gets treated the same. So if you're a huge system, HUD charges you the same credit enhancement fee as if you're a critical access hospital or a district or a rural hospital, right? So this program, as opposed to bonds where you're just kind of talking kind of mathematics and creditworthiness with bond investors, there is more of a social good to this program because FHA, they make you, in your application state why your hospital is needed and kind of go over, the population that comes to the hospital and everything else. So, from my experience personally, in the last few years, the deals we've done with this program have been, some urban hospitals, like in Los Angeles, and San Diego. And then we've done, several rural hospitals. We did some in Montana, we did some in Colorado, that in both scenarios, the hospital is very needed for the community. They were not investment grade. They qualified for HUD. And there's a social reason, that the government should have helped insure these deals. So again, it can be used for construction and refinance. It takes a little longer, it takes a little more hand holding, but for houses that aren't rated, it's a very good option because you end up with a debt cost that's just as good as a A-rated household system, in your state or town. So with that, Ross, you can go to the next slide. So kind of like talking about FHA, USDA, the U.S. Department of Agriculture, they have a program called the Community Facilities Program. This program finances a whole host of businesses. The main qualifying factor is your population has to be 20,000 people or less. and they'll give you direct loans, and they'll also guarantee loans by banks, resulting in very, very cheap rates. You can see the biggest pro is the direct loan program is 40 years in amortization at a current rate of 350. They publish the rates, and it kind of is what it is. They'll do construction. They won't do 100% refinance. So in this program, you have to at least do 50% of your deal has to be construction. So if you're a rural hospital with $5 million of debt and you want to use USDA, you have to do a $5 million, capital improvement project along with it, and you can qualify for the program. Other benefits, they do allow parity debt, so you could have bank debt with it or other sources of debt you might have. Again, like HUD, minimal financial covenants. Negative, again, being a government program is long lead time. We say 12 to 18 months here because these are usually construction projects. So once you're working with your contractor and thinking about what your project's going to be, you kind of apply to USDA and get the ball rolling, because they like to look and talk to the contractor and make sure that you're using all the correct governmental forms they want you to use. It's just very procedural. Again, you have a debt service reserve fund that you fund over time, just like HUD. And another negative, and especially for the Western region, we have to look in is for these governmental programs, you have to do some upfront environmental work, phase 1 environmentals, other analysis to make sure you're not disrupting anything within the federal purview. So unlike bonds, it's more market driven. The federal programs have a little bit more rules, but the benefits for both of them are it's cheaper money, it's fixed rate, and you don't have to be investment grade or have a large project to go through these programs.
Yeah, and I think that also too, on just as far as the lead time to close, I think it's worth noting, just because we have all of Region 10 on the phone, is that the state office and whatever state office is processing it can have a big impact. I mean, some are faster than others.
Yeah, definitely. So I think at this point, Ross gave an overview of the markets, right? Which, from our perspective, are that historically it's still a great time to borrow long-term fixed rate. Short-term rates have been volatile. The Treasury's gone up and down. The Fed's starting to raise rates. Our economy is showing some better numbers, so we envision a little bit of inflation. That might affect some of the borrowing we didn't go over, right? The asset-based lending, your accounts receivable financing, bank lines of credit, some of that stuff. But the stuff we're looking at being long-term fixed rate, we think it's still a great time, comparable to when you compare it to any prior period for a decade, 2 decades back. I mean, the rates we're seeing now are very strong. And to kind of show how we put some of this in practice, because going through all these options and showing the slides and the finance, I mean, I know it can kind of glaze people's eyes over, but we wanted to go through some case studies, which can show you how this works in practice. We try to select 3 hospitals that are different in size and location to show how we used these products we kind of went over. So with the first one, I want to go over. This is a hospital. It's called Antelope Valley Hospital. It's a district hospital in North LA County that provided disproportionate share Medicaid residents. Their service area was kind of the same as Las Vegas, but they only had their hospital and one other for-profit hospital in town. So they obviously were very needed. It's a client we worked on, since I've been working on for 7-8 years now. And they had kind of a debt structure we were working on fixing, right? So, these bullet points, I'm not going to go through all of them, but being a district hospital, they weren't investment grade rated, right? They were right in the cusp. They were double B plus was their rating. So right in the cusp of being investment grade versus a junk bond. So their hospital board determined that they want to evaluate HUD, the refinance program, along with public bonds. They couldn't do USDA because they're too big of a city. They couldn't really do bank bonds or private placement like we talked about because they wanted to get 30-year money, long-term money, and fix their rate. So we worked with them on both options. Went down both routes, and it ended up, because of the timing when we locked these rates, and also because as a district hospital they had some legal board issues that were tougher to work through with HUD. They determined that bonds were their best option, right? So, that market back then the pricing was a little better than it is now because, rates were lower. But that hospital ended up, just making the decision to go fixed rate bonds. And then, they're locked in, for the next 30 years. So their capital program's done. If they want to borrow, they can add a series, the flexibility is there. So that's one structure where, our company being agnostic and showing them the options, the board selected bonds for their, to work on their future. Now, the next one was a district hospital in the San Diego area. A little smaller hospital, a more affluent area than Antelope. Still, was the high Medicaid provider in the area. So when we looked at them, they had no rating, right? So it wasn't even like they were rated double E by the agency. So they had no rating, never had gotten one. So they'd be a brand new borrower to the bond markets. Their board wanted us to look at bonds for them and also look at FHA. On this deal, because they didn't have a rating, they were new to the bond markets, the quotes for their debt were high, they decided to go use the 242 program. The reason they did it is because that program, if you recall, it's very easy to add a second mortgage in the future, which they needed to do a seismic retrofit for the hospital being in California. So this district, they made a decision to actually, go to HUD instead of bonds because of their ability to access that market easier. And my third example is a totally different hospital. This hospital is in Arizona. It's a critical access hospital, 60 miles outside of Phoenix. So, they were obviously too small to issue bonds or try to get rated. So the fixed rate bond market was probably, out of question. They had a great project to build a surgical center, a new GI suite, and an MOB for the community. It's a beautiful city. The hospital did well. So their options really were bank private placement, right? Which maybe is a 7-10 year term with a balloon payment, good rates, but there is some repayment risk. Or because the city had 20,000 or less people, we could do USDA. So we pursued both options, and USDA, they loved the deal. The hospital did well, and they decided to fund the whole thing with a direct loan, which came at 3.5% for 30 years, which that would be an impossibility for a critical access hospital to get in the tax exempt markets. So this hospital, working with Phoenix USDA, did a great job, and working through us, we're able to get a really low rate and build this project, and finance almost all of the construction costs. So these are three examples how it worked in practice. We have countless others, but we wanted to cover some that use some of these different strategies we went over, and hope that these strategies are interesting to those on the webinar. And I don't know at this point, Nikki, if there's any questions, we can open it up. And like I said, everyone has the PowerPoint, but Nikki, I'll leave it to you if there's any questions. But that's all I have on the case studies.
Great. Awesome. Thank you both, gentlemen, for this great collaboration. Great to hear those different perspectives. So before I take our first question, just want to remind everyone, in order to submit yours, you could just type it into that questions panel over to the right-hand side of your screen, and we'll take as many as time will allow. I will address one question about accessing the replay. The slides themselves are available now, so you can get that from the handout section, but the replay will be sent separately. Actually, Colorado HFMA does a great job of posting these to their website, so you should get a follow-up directly after this. Well, not directly, but within a few days after today's event. All right, so let's see if we have any other questions that have come through. Really, there's a lot of information that you covered, but for a critical access hospital, what would you say would be the number one takeaway from your presentation?
For critical access hospitals, we've done a lot of those, and I think the number one takeaway from projects we've seen or tried to finance is that when you're looking at a project or any construction project, it's very important to see what your debt capacity is and what you can afford based on your operations, your core operations, and then to really get someone, it could be someone like us or a financial advisor or someone to run, an analysis of what you can repay with the programs of what your rates can be. Because what I've seen too many times is critical access hospitals that, the architect's done a great mock-up first, and they say, we have this new construction project that's $45 million. If we keep our Medicare at this level, we'll get cost-based reimbursement on interest or whatever structure they can get within each state. I know sometimes it's different on the capital kind of kickers, but then it's a project that's either too expensive or too big, or no one will finance, and then they kind of lose a year, they lose money in planning, they lose enthusiasm for their project. So I would just say for critical access, we like to be involved or like I said, an advisor to help them make sure they can afford what they're planning and make sure they access, frankly, USDA has been the best source for us for critical access. Make sure that they let the state director know what they're doing, what projects they're looking at, and see how much money the state USDA has, because that's the cheapest money for a critical access hospital.
Great. Thank you for that. And I'm assuming the case study that you referenced, as well as any other similar type of use cases that you have, if anyone on the call is interested in taking a deeper dive, they can access you from the contact information you provided?
For sure. And our website, which is lancasterpollard.com, has a lot of case studies in our hospitals. We have white papers on financing options. I mean, we have white papers on small and rural hospital finance. So yeah, they can email either Ross or myself. They can play around on our website. But if you can't find anything, or if you have a detailed question, for sure reach out. We do a lot of board education and other types of education just like this session. So we have a lot of data that we send to our hospitals.
Perfect. Thank you for that. Okay, so as we approach the top of the hour, I just want to take this time to thank our members and the healthcare community for joining this call. Be sure to keep an eye out for an invitation to join next month's webinar as well, which is scheduled for May 15th, and it's called Why You Got Hacked. So that should be equally interesting to hear the presenters for that one. As you exit, you will be prompted with a survey, and we would appreciate you sharing any feedback about today's event. If you watched this with someone else in a room, in a conference room perhaps, we'd love for you to provide their contact information so we can ensure everyone gets their credit from HFMA. And you can also let us know about any topics that you'd like to hear on future webinars. So thank you again to our guest presenters, Ross Holland and Jason Dopulas of Lancaster Pollard. Thank you both, gentlemen.
Thanks for having us. Yeah, thanks for the opportunity, and thank you to HFMA Region 10, and hope everybody has a good day and a good week.
Awesome. All right, guys. Thanks, everyone, and have a great afternoon.
Thanks, you too.